Hi, folks. This is Mike Zlotnik, Big Mike, and today we're going to have a short discussion on what's happening with the interest rates, the Federal Reserve, inflation, and stock market. Just a couple of comments. These are my personal thoughts. So first of all, interest rates, 10-year Treasury, 5-year Treasury, 2-year Treasuries. The rates on these bonds have calmed down. And that's actually great news for real estate, and that's great news for stock market. I mean, that's the reason the stock market, in my view, is having a little bit better days. As interest rates rose, that became more expensive for leveraged corporate balance sheets to service the debt. And generally, higher interest rates are not good news for stocks. So the fact that the rates have retreated a little bit from their peaks, or at least short-term peaks, the stock market has shown positive reaction to that. That's my opinion on that front. As far as long-term outlook for interest rates, well, Federal Reserve will continue what they're doing, raising Fed funds rate. That's what they control. That's one of their major levers. And then the bond market typically responds, especially with short-term interest rates. In addition to that, other indexes linked, well, they're not linked, but they typically move in some level of connection to what the Fed does. So prime rate, SOFR rates, all have gone up 75 basis points since the Fed has raised its Fed's funds rate. And prime rate and other rates, LIBOR rates, they all impact what happens with the borrowers. So the cost of borrowing, especially short-term capital, has gone up. But the bonds are signaling the fact that the market is not really afraid of the Fed action. In essence, the market is at this point projecting that the Fed will slow down their rate increases sooner rather than later. So it's a speculation, obviously, it's a projection. But the bond market is a much larger market than any other market in the world. And that is telling us the economic slowdown is already here, and the inflation should be coming down. Although we don't control supply side of the inflation, but the demand side, consumer sentiment has been substantially weakened. That's one of the things that concerns me, is that U.S. economy is based on consumer spendings, and consumer sentiment has been softening. So we are headed into some level of recession. We already are in some sort of level of a recession. So a couple of just conclusions from this whole discussion. Number one, the fact that the bond rates have retreated is something that I was already projecting and predicting. Listen to some of my recent recordings. My view was that 10-year Treasury topped out at 3.5%. And now it dropped below 3% and settled at a lower level, which is, in my view, great news for real estate. And some of the real estate projects we're working on, that's absolutely good news to have interest rates, at least long-term 10-year Treasury, stabilized below 3%. So that's on that front. As far as most of the investors and where to put fresh cash, well, I give no advice, obviously. Some folks have been thinking about putting money in the stock market because it has shown some level of a correction. Sorry, not a correction, but the recovery from the correction. And that is obviously what is on the surface. In my view, it's still a dropping knife. The stock market is not done correcting. I have no expert knowledge in that. It's just my personal opinion. I'd be careful right now putting fresh cash in the stock market. I do believe that solid real estate deals continue to be very attractive. We actually have a great deal coming up. Folks who are watching this, you'll see another email launch of a deal called Michigan 4. It's 4 properties in Southeast Michigan, suburbs of Detroit, solid Class B plus properties. We're very excited about the project, and the good news on that project, obviously, as interest rates retreated, it provides better financing for the project. And most of the value add projects, the returns are generated through the work of the operator much more than they're generated through what the market does. So something really important to keep in mind. Rent inflation is still pretty strong, although I would expect things to start slowing down. Consumer sentiment has softened, but the employment is still full. So as a result of a full employment, the wages are still rising. So we are in for some level of elevated inflation for a substantial amount of time, but I do believe that the inflation has peaked out and we will see some level of retreat over upcoming multiple months. So that's about it today. Just kind of a short summary of what's happening out there. We'll continue to update you on what's happening in the market. If you have interest in this upcoming deal, please reach out to Alina. The deal information is coming shortly. It's a very exciting deal. I will leave the rest for that follow-up email. Stay tuned. Appreciate your time and attention, and enjoy the rest of your summer.